Hey guys, how are you doing this morning?
Doing
Good
well.
morning. Good morning, Robin. Good to see you.
So what does everyone have going on this week?
Um, I want to go ahead and dispel sort of a common misconception that a lot of folks have, which could be limiting the amount that they are saving for retirement. So, a lot of times when folks are contributing to a 401k plan, they know, and I say no, we can use air quotes here, that they could contribute a maximum which changes from year to year. In 2024, that contribution limit is $23,000. And if you are over the age of 50, you could contribute an additional 7,500 for 30,500. So when a lot of times people are talking about contribution limit, those are the numbers that they're talking to. However, 401k plans have a much higher contribution limit that I would like to explore with everybody. So I got a little whiteboard here. Let's see if we can get this to work well.
We believe in you, Skylar.
So here we go. So the contribution limits are 23,000 for a either a traditional pre-tax contribution where you get the tax deduction up front, and then distributions are fully taxable as ordinary income. Or you could do Roth contributions where you don't receive a tax deduction up front, but then all of the growth and distributions are tax free when you go ahead and take the money out. If you're over the age of 50, you get to do that extra 7,500 that we talked about. But what I wanted to explain is that the real contribution limit to a 401k plan in 2024, at least, is $69,000. And then you get to add the $7,500 catch up contribution if you're over the age of 50.
Okay.
So that's a lot bigger of a contribution than, 23,000 or 30,500. And so this is the total amount that can go per participant to their account. And that can be made up of the regular contribution limits that most people think of, plus employer contributions, plus a contribution that people are less familiar with, which is an after tax employee deferral. So the total being $69,000. If you contribute 23,000 to your plan and you receive zero match, that would leave up an additional $43,000 of contribution that you could make after tax.
46, right?
$46,000 of contribution if you receive no other match. So the total amount that could be contributed to your account is $69,000. You can contribute pre-tax or traditional 23,000. That $46,000 difference can be a combination of employer contributions and after-tax employee deferrals. So an after-tax employee deferral works a little bit different than traditional or Roth. You don't get the tax deduction for making the contribution, and then the distributions, what they do is they track how much you had contributed versus what the gains are. What you contributed when you go ahead and take a distribution is not taxed, but any of that investment gain is taxable. So there is a way, though, if your plan allows, that you can potentially do an in-plan Roth conversion. And so if you contributed 23,000 on a pre-tax basis, you get the full tax deduction up front. Then you could contribute the 46,000 on a Roth basis, or I'm sorry, on the after-tax employee deferral basis, and convert that to a Roth and end up with a $46,000 Roth contribution. your $46,000 contribution is reduced by any matching contribution that you receive from your employer. But this is just a great opportunity to really supercharge your savings rate if you have the cash flow.
So is there a time limit that you have to wait before you're allowed to do the Roth conversion if you proceeded the way you just explained?
That's going to depend on the plan document. So this is really what the law allows. Your plan document that you can request from your employer will outline all of the different contribution types and whether or not it allows for an in-plan Roth conversion. And my thought is that if you were going to do this, you would want to do the conversion as soon as possible to limit any of the investment growth that you have on the after-tax employee deferral basis, because those amounts, any of that investment gain would be subject to income tax.
Mhm.
So if you can make the Roth contribution and then, or I'm sorry, if you make the after-tax deferral and convert it to Roth, the sooner the better, because that way you avoid paying tax on any of that investment growth later on.
That's smart.
Yeah, and many of the record keepers allow you to convert every paycheck on an automated basis. You don't have to log in and do this transaction. Many of them allow for it to be converted automatically. So who does this apply for? I mean, I think the first one that obviously this jumps out, like Scholar said, is for cash flow. So this is prime earning years. Maybe you're earning more money than you need to live on right now. What's the maximum you can do? I think that's commonly the way people think about that. But two other use cases is really anyone that has a non-qualified investment account or after-tax money. So maybe they still need their salary to pay for their expenses, but they have other money, either an inheritance or savings from previous years. So if I meet somebody and they have $200,000 in an investment account and they have access to save more into their retirement plan, I'm going to be pushing them to take full advantage of that. So maybe they still need their salary to pay their bills, but yet they have this other pot of money that they could be using to pay said bills. So that's another scenario. The third one I've seen this used on is maybe somebody partially retiring or in like a consulting role with their previous employer. So if they're maybe only making $40,000, they could put all $40,000 into the plan. So you
As
could do
long as
that
it's
on
only earned income.
yeah, earned income. So
Okay.
so they're working on a part-time basis, a couple days a week, couple days a month, whatever it might be. They might commonly think they can only do 23,000, or even think they're not going to save in the plan because they're not making that much money. But the use case that I see for this is, hey, you can put the whole amount in the plan. You could do all Roth, $23,000, like Scholar mentioned before, $7,500 for the catch up. So that puts us at 30,000. And then that extra spillover, $9,000, $10,000 can go into the after tax contribution converted to Roth. Effectively, they made $40,000 and all 40 ended up making it into a Roth account at the end of the day, which may benefit that individual and their spouse. But down the line, it almost certainly is going to benefit heirs, children, grandchildren, that type of thing. So Skylar's right, free cash flow. Second is somebody that has non-qualified money, savings accounts, taxable investment accounts. And then third would be somebody kind of on the sundown part of career where they're slowing down but still earning some income. This is a good opportunity for them to take advantage of it.
And probably the best person to take advantage of this would be somebody that is self-employed, or if it's a husband and wife power couple, because then you could effectively, for a solo K plan, if you just are in business yourself and if you have the cash flow and you have the income from your business, you could save $69,000. Or if you're over 50, 76,500. So a lot of times folks you might think in an IRA context of, hey, I can save $7,000 this year, but really it's 10 times that amount, and you could do it on a Roth basis. If you're married and both spouses are working in the business, you can actually double this. So like if you're high income, solo entrepreneur, this is perhaps one of the most powerful tax shelters available, and you can set it up and really make this thing sing.
I think it's important then to work with the client's CPA to make sure everybody's taking full advantage of these opportunities available to them. Cool. Well, thanks, Skylar, for sharing that idea.
Hey, thank you guys.
Thanks, guys. Have a beautiful day.